So we tell our clients and our prospective clients that our goal is to compound their capital at an above average rate while incurring a below average level of risk. So let's start with the back end of that. What do we mean by a below average level of risk? Well, the businesses we own typically have the following characteristics. They have more growth. They have higher returns on capital. They have stronger balance sheets and frequently lower valuations than the market. So on their face, they're less risky. It's observable. It doesn't have anything to do with volatility, because our belief is volatility is a risk only in the short run. If you have an obligation in a year to buy a house or to do something like that, you probably don't want to speculate with that cash that you have set aside for that. But if it's 5 years or 3 years, you have the ability to put that money at work and have it work for you. So volatility is not in our lexicon, basically, in terms of risk. And we've already talked about what average is, and we think average is roughly high single digits, maybe low double digits. And it has to do with what the overall interest rate environment is. And so there are lots of investors, Michael Steinhardt and people like that, who retired with records of very high rates of returns. But that was against the backdrop that in January of 1981, the long bond, the 30-year Treasury, yielded 15 3/8%. And prime rate was 21.5%. So it was in a backdrop in which rates were much higher than they are currently. So returns in all businesses are lower these days. And my guess is average these days would probably be at the low end of that sort of high single digits number. And because it's an average we're talking about, it does not mean that we will have a return on any given year that's better than that. It means to us over a period of 5 years or 10 years, our returns are very likely to be well above that number. But I would say, if observably, maybe a third of the years in the last 25, we maybe have done less well than the S&P, which is, we use that simply because it's available. We don't care what indices people want to compare us to. That's their choice. We spend no time thinking about that. But the record that we have accomplished for our clients, I'll just tell you I'll give you some numbers very, very quickly. Our separately managed accounts, which we've been doing for 27 years, have compounded at 12.7% versus the S&P at that period of time of 9.4%. So a little over 300, it's 330 basis points over the market, compounded annually for 27 years. We have a private investment partnership that's been around for 23 years, and it's compounded it at 15.25% net to the partners versus 9.2% for the S&P during that specific period of time. So 23 years, 600 basis points over the market. We've run 2 mutual funds in our life, the FBR Focus Fund and then subsequently the Akre Focus Fund. Those 2 records combined, the number is 13.2% versus 7.7, 550 over the S&P, over the S&P for that period of time, 19 years. And then simply the fund that we currently manage, the Akre Focus Fund, which has been in existence a little over 7 years, it's 125 basis points over the market. And the market has been 13.5% in that 7-year period of time. So I just say that, and I don't print them for you, but I just say that to say this is the outcome of using this thought process in our investments. Saurabh has asked that maybe we talk a couple of minutes about some examples. And going way back into the 80s and early 90s, we invested in a company called International Speedway Corporation. And International Speedway had the characteristics of it was 12 times earnings, it was 26% return on equity. It had an owner-operator who owned 60% of the stock, and it had a lot of growth in front of it because it was the dominant racetrack owner in NASCAR racing. And they owned International Speedway in Darlington and Talladega. They went on to build some more. It's not a very attractive business in my mind today for a bunch of reasons. The man who ran it, Bill France, passed away. His daughter's taken it over. She doesn't have the same skill set that he had, but during that period of time, we made 10 to 20 times our money on that business over more than 10 years. Another company that was also in the entertainment-related business was a company called Penn National Gaming, and the way these, there's a lot of serendipity about the way these things come out. A young man who was working for me at the time, talking to another investor, said to us, well, you ought to look at the 10Q of this company called Penn Gaming. And we did. And in Penn Gaming at the time, in Pennsylvania, Sorab was in Philadelphia there, in Pennsylvania, had 5 off-track betting parlors in Pennsylvania. And they were limited by licenses in the state. There were only a total of 23 in the state. So you had a high barrier to entry because of a regulatory issue. And what was interesting in this 10Q was the 5th off-track betting location that they built cost them $2 million to build it out. And they had, $1.6 million of operating income in the first 12 or 14 months. I'm saying that's not a bad business, I took it upon myself to go meet the CEO. We talked about the importance of people. He was a real estate developer by background. His father had control of this old racetrack, Penn National Gaming, that had, because of Pennsylvania, they had given the licenses for the off-track betting to the legalized gambling arena, the racetrack, the horse racetrack business. And he was ambitious. And as a builder and developer, he borrowed a lot of money in his lifetime, and he told me that he had been able to avoid ever having his wife co-sign a loan. That's a really important measure of risk understanding. And so I got involved, and it was after that he bought another racetrack in West Virginia, about an hour and a half from Washington and Baltimore, and converted that into a casino that now has 5,000 slot machines. And he went on to become the largest non-Las Vegas, non-Atlantic City casino operator in the country. And it's another case where we made 10 to 20 times our money in our accounts. Again, this was a situation of high returns on capital, low valuation, major shareholder, owner, and operator, and a low valuation with a huge opportunity for growth going forward.